Few announcements. First thing is about the assignment. So now it's already been posted in the Google Classroom. You can go through that. As I mentioned last week, this is about central counterparty, which is related to counterparty risk management. In Sri Lanka also we are going to it's planning to set up a central counterparty maybe within next 2 years. So better you have some idea or understanding about what is the central counterparty and what is the mechanism, why do we need these things. So therefore this is a brief introduction or background. What I need is you to explain in your assignment. This is an individual assignment again. We cannot have group assignment in this environment. So this is an individual assignment. Again, what I expect you to explain what is a central counterparty, how a central counterparty could reduce counterparty risk. Then you have to explain what is a counterparty and why this is required because of this counterparty risk. Then how this central counterparty can help or reduce the counterparty risk. Then what are the advantages of having a central counterparty? Last, central counterparty itself faces risk. Though the system is or the central counterparty is intended to mitigate counterparty risk, as we discussed so far, when you try to mitigate one type of risk, you may face some other type of risk. Likewise, when we try to mitigate counterparty risk of the individual institutions in the financial system, then the central counterparty may have will face different risks. So please explain what are those risks and what are the risk management policies and procedures can be adapted within a CCP. Why do we need that? So that is the requirement. So again, I have limited the word count to maximum to 3,000. Better to be hang around there. And as I mentioned in the previous one also, don't try to just copy and paste. You can refer any website or a book or any article, publications, whatever. It doesn't matter. You do your research, study, and write in your own words. When necessary, you can place references. So, and the deadline is 31st October. Again, you can submit online through the Google Classroom, either Word format or PDF format, not images converted to PDF. So readable PDF or a Word document. Then we can, through Google Classroom, we can check the plagiarism and things like that. So that's about the assignment. Any question? Remember, deadline is 31st October. You have the whole month. Any questions on this?
So I didn't hear the first part. Can you explain a little bit?
Sorry?
First part, I couldn't hear you properly. Can you explain the first part a little bit? Just first.
No, basically these are the things that you have to address. What is a central counterparty? Why do we need that? And how a central counterparty can reduce counterparty risk, and what are the advantages of having a central counterparty, what are the disadvantages, and central counterparty itself faces risks. What are those, and what are the risk management policies and procedures we can adapt within the CCP to reduce the risk of CCP and the system. That's what you have to write. Again, word count is given. Anything else?
Sir, when is our exam, sir?
So from this week, if we go another 3 weeks for the regulations, then do you need a revision class? So that will be end of October. So if the environment or this situation permits us, we can have it towards the end of November.
Okay.
We try. If not, that depends whether we can ask you to come to the exam center.
Okay, sir.
However, the course will be probably finished by this month. The other thing, the revision class. So we can have it on 31st. Then there's uncertainty whether we'll be able to have the exam in 2 weeks' time. So if it get delays, there's a problem. Or alternatively, what we can do, we'll stop the course here without having the revision. Then when it is possible to confirm the exam date, then we can have the revision class closer to that exam date. It's up to you to.
So most probably exam will be on November. No?
Most probably November, yes, towards the end of mid-November.
End of November or mid-November?
Probably within last 2 weeks, if it is possible, if we can finish by 31st, and if they allow.
Okay, sir, thanks.
Sir, only one revision class conducted by you, sir?
Yes.
Other than sir, only 3 lectures are left with regard to regulation. That's it, no?
Yes, I think probably 2 or 3.
Okay, sir.
Okay. So the next one, the other announcement that I wanted to make it. You may aware from next week onwards, for the next 2 or 3 sessions for the on regulations, classes will be held in the evening, not not in the morning. 1:30 to 5:30. Please note that. But after that revision, again, we will have it in the morning.
That regulation will be done by another lecture?
Yes.
So excuse me, I have a question. These assignment marks will be added to the, will be taken into consideration for the final examination, no?
I didn't get that. Which mark?
The assignment marks.
Yes. Assignments, yes. I think 30% for the assignment, no? That's what our allocation.
Yes. That's what I want to clarify.
Yes.
Thank you.
We'll take that.
Okay.
So 15 marks for each assignment, is it?
Yes,
okay?
yes. Anything else? If not, we can move into our topic, credit risk management. This topic, credit risk, it can be a separate course or a diploma kind of thing. So therefore, we are not going to discuss each and every aspect of credit risk management, but I'll give you a brief introduction on credit risk, and then mainly focus on the counterparty credit risk management, because that is what more relevant for a treasury and related functions. I think you know a lot more than me about credit risk. You might have learned a lot of things about credit risk, and you may perform duties relating to credit risk and credit risk management. So I expect you to be more interactive in this session. You can share your experience as well. Okay, what is credit risk? What is credit risk? Have you ever heard about that? What is credit risk? What is credit?
Credit risk means uncertainty during the lending process.
Uncertain during the lending process.
Yeah.
When do you say lending process? What is the beginning of that process and what is the end of that process?
Beginning is customer requesting a loan facility from the financial institution, and is somehow recovering that loan facility in a better way from the customer.
In that sense, yes, if you go in the process, once you recover everything, the loan you granted, yes, it's yes, that the answer can be accepted, but up to some extent, because when you say uncertainty in the loan process, there can be lot of things. Not that all things are considered as credit risk. Even in that process, there can be legal risks, operational risks, things like that. But credit risk is a specific thing. What is that?
So risk of defaults.
Risk of default. Yes, yes, good. That's a in simple, you can say it's the risk of default. What do you mean by default?
Non-payment of the
Non-payment of the
credit facility.
whatever due payments, say. So there can be a payment due. If you don't pay it, it's a sort of a default. Say you get your electricity bill, water bill. There's a date, so you have to pay by within this dates or something like that. If you don't pay, it is a sort of a default. The service provider, water board or electricity board or LECO, they take that risk. They provide the service in advance. Then they take the risk of the credit risk of their customers. They may not pay the bills or the charges for the service provided on time, or may never pay it. So that is sort of a credit risk. It's not only banks face the credit risk. Most of the business, unless that small business, those who do it cash and carry model, that means you pay and get the goods, or you pay and get the service simultaneously. Other than that, almost all other businesses face the credit risk. So basically, credit risk is the probability that the borrower, whoever who obliged to pay, may not pay that dues on time and full amount. That is the basic. There's a chance that can happen. The borrower may not pay the dues. So how do you decide whether the borrower has fulfilled the requirement or not? There should be an agreement, proper agreement. So based on that agreement only, you can decide whether it's a default or not. So the risk can result from various reasons. The simplest and simplest form is clear one is the default on a financial obligation. You have whatever money the borrower has to pay, the borrower will not pay, default. So failure to make the obligation, that's the obvious credit risk. But not only that, in the financial market especially, we can consider increase in the chance of default. also as a part of credit risk. So say you evaluate a customer and you think there's a 90% that the customer would pay back this loan, but with the time, due to whatever reason, that payback chance dropped from 90% to 75%. You increase your risk. That is also can be considered as credit risk. The other thing is, due to various reasons, the actual loss that you incur due to credit event would be much higher than what you expect. You expect only 200,000 rupees loss, but by the time of the default, actual loss would be 500,000, something like that. So that is also part of credit risk. Related to that, what is the amount that you can recover? So by the time of default, you may have the exposure amount or the risk amount lent, maybe 500,000. You may expect at the beginning, if something goes wrong, we can recover 90% of that or 80% of that. But actually, after the event, you may be able to recover only 25%. That is also considered as credit risk. So the recovery is less than what you expect. The last point is not, as I mentioned, so default on payment for goods or services already rendered. It's not, this may not be relevant for banks and financial institutions, but in general, this is credit risk. As I mentioned, water board or electricity board, they provide the service and expecting customers to make the payment for those services. That can happen in many industries. Either way, some industries, first you give money. First you have to pay money, then only they produce the goods and deliver to you. There will be a delay in that. So there will be a time gap, and they may not deliver the goods at all, or not in the expected quality or expected shape or whatever. That can happen. Make the payment in advance and waiting for the goods or service to be delivered. In that situation also, we take the credit risk. It can happen other way around. First, the supplier or produce goods, deliver goods, and after that, they may give a 1 month or 3 months credit period to pay for those goods or services. You may never get it. So that is also part of credit risk. So therefore, credit risk is not relevant to financial institutions or banks. So it is everywhere. But the thing is, other industries, they can avoid. If they don't want, they can say no. If you pay cash, then only I deliver goods. So cash and carry. They can adapt such models, or the way of mitigating credit risk is maybe different in those industries. But in banks, especially in banks, credit is a must. Giving credit is a must because bank take deposits from customers and grant loans to customers. That's the business. That's the business of the banks. So you cannot avoid credit in a bank. So therefore, it is very important in banks and other many financial institutions to manage the credit risk. What are the sources of credit risk? Again,
Sir, excuse me, sir.
yes.
I have a question with regard to that recovery. Expected recovery, how can do it? Is there any way that we can calculate?
Yes, you should be able to calculate what would be the recovery based on the past experience and with forecasting models. You should have some estimate on what would if a default event occurs, what would be the recovery. That you need, it is required to calculate your capital requirements and things like that.
So it is based on past experience, right?
It's a one way. If you can forecast things, what would be the cash flow? So worst case, what if say you have grant a loan to a company or a customer, then you should have a model to say if the income levels or the business of this customer falls below a certain threshold level, then it can trigger a default. If that happens, what is his net worth? What would be the repayment capacity? Then by that time, what would be our exposure level to the to that party? Then what would be the amount that we can recover depending on the position of that party? There should be analysis, something like that.
So are there any models for that recovery, expected recovery, like for such as for expected exposure?
Yeah, there are methods. Yes.
Okay.
So what are the sources of credit risk? So I'm not going to discuss here the some of the retail events, but major sources in these loans are not given, but loans, all those facilities are sources of credit risk. But in a treasury, especially these products would occur because treasury does not grant any loans. So bonds and money market instruments. Treasury invests in bonds and money market instruments, maybe call money market or short-term deposit with another bank, or maybe nostro balances, things like that. So that give you a credit risk. If you buy a bond, invest in a bond, there is a credit risk. Whether the issuer will pay the coupon on time, exact amount, or whether the rating will be downgraded of the issuer. Issuer rating will be downgraded, whether that can happen. Or on the maturity date, whether the borrower or the issuer will be able to pay back this maturity proceeds, whether the issuer will exist by that time during the time period of the bond, so until maturity. So that kind of risk is there. So therefore bonds and other money market instruments, they give the exposure to credit risk. Repurchase agreements. What do you do in a repurchase agreement? What do you do in a repurchase agreement?
You either buy or sell with the expectation of doing the reverse in future.
Yes. But yes, in a way you can say buy or sell. But exactly in a repurchase agreement, if you are the repurchase party, repo party, what do you do? If you are the repo party, what do you do?
Sell security.
Sorry?
Sell the security and agrees to buy the securities in the future.
Yes. What do you do? Sell security and with an agreement to buy it back on a future date. So you sell the security, you get cash. What is risk? What is your risk?
So reinvestment risk.
Reinvestment risk of what?
Of those money.
Whatever the money you receive, yes, you have to reinvest. But you do this transaction with some intention where either you short of cash or something like that. What is the credit risk there? Is there any credit risk?
No credit risk.
No credit risk. Why?
We have to pay no.
You have to pay cash with the interest. Other party?
He has credit risk.
Huh?
He or she has credit risk.
Yes. You don't have any credit risk.
Yes.
Yes. In a way, yes, you can say. But if other party fails, what would happen?
So other party fails means that means he does not or she does not buy give his money. Is that the risk?
No, the other party does not. There's no obligation to pay money. You have the obligation to pay money because you have already borrowed funds as a repo party. But on the second leg, you should pay cash or transfer funds. The other party has to deliver
Security document.
securities. What would happen if the other party is no longer there? You won't get your securities. So that risk is there. But as you mentioned, mostly in repurchase agreements, the credit risk we discuss from the reverse repo party, because that's the party give away cash and take securities as collateral. So the reverse repo party takes the risk of the repo party. The securities that you get is just an collateral. If the other party fails to deliver, or the repo party fails to deliver funds, then only you can acquire that collateral and sell that collateral to recover your funds. We will try to discuss that more detail later. However, that's the mechanism. Therefore, through repurchase agreements, you face credit risk. In foreign exchange transactions, how do you face credit risk?
So not settling the transaction on the value date.
Yes, not settling in the on the value date. I explained that last week. One party has to settle in Sri Lanka, other party may have to settle it in US time. So there's a time lag. Maybe the dollar receiving party may not receive funds. So that risk is there, especially when it comes to forward transactions. What about forwards and options? In forwards, again, in any underline, on any underline, forwards, both parties face the credit risk because you don't know whether on the settlement date of the forward contract, whether the counterparty will pay you or not. So therefore, forward contracts, they carries the credit risk. What about futures? What about futures transaction? Is there any credit risk?
So there's a central system, right? So and for a future you have to keep the margin as well, right?
Yes, for futures you have to keep the margin.
So there may be
What is that central thing?
So that is futures exchange, right?
Yeah, futures exchange and the clearing house.
Yeah.
You face the risk of the exchange house. So therefore, we assume there's no credit risk, though there's a very small credit risk there. Basically, we assume there's no credit risk in futures because the clearing house or the futures exchange is the counterparty for you once you entered into the futures contract. What about options?
So if the option is not exchange traded, if it's OTC option, then there is risk.
Yes,
right?
if it is on OTC options only, there's a risk. To which party? Both parties or only one party?
To the option buyer, right?
Yeah, to the option buyer, because option buyer pays the premium, and on or before, depending on the type of the option that you have bought, you go and make a claim depending on the market environment. By that time, option seller should be able to honor the transaction, but it may not. So therefore, option buyer takes the credit risk of the option seller. For the option seller, there's no credit risk as it collects the premium only, and option buyer has no obligation towards the option seller. Then the interest rates and currency options. Sorry, this is not currency options, currency swaps. Interest rates and currency swaps.
So there's credit risk towards both the parties because both of them have to deliver, right?
Yes. Generally, you can say both parties face the credit risk. But at a given point of time, would the both parties take the credit risk? Consider an interest rate swap.
So if the rate turns out to be in favor of one party, the other party can lose.
Yes, when in an interest rate swap, there are two interest rates involved. So at any point of time, there will be a favor towards one party. It can be for the fixed party or the floating party. If both are floating rates, one floating rate is maybe higher than the other floating rate. So, and who is going to pay and who is going to receive. So depending on that, there will be a one party having a profit, whereas the other party is having a loss. So then which party, say party A is having a profit, party B is having a loss, then which party takes the credit risk?
So winning party has the credit risk.
Sorry?
Winning party has the credit risk.
Yes, winning party or the who is having the profit takes the credit risk, because if other party defaults, he may not be able to get that profit. So the winning party has the credit risk, but in the event that there's a exchange of principal at the maturity, then both parties takes the credit risk of the other party, because especially in a currency swap, yeah, in a currency swap you have to exchange the principal amount in two different currencies. Then again you face the settlement risk in that transaction. So therefore, both parties takes the credit risk. But during the currency swap period, again, one party is making, one other party is losing. So the party who's making money or having a profit takes the credit risk of the other party. So therefore, even forwards, that can happen. If you do mark to market, one party takes the is maybe in having advantage position, other parties in a disadvantage position, even in a forward. So therefore, for most of the derivatives other than options, credit risk may change from one party to another party. Oh, that means between the two parties into the contract, depending on the market and which party is having the profit. So always the party who's having a profit takes the credit risk of the party who's having a loss. That's what happened in derivatives. Is it clear?
So in case of options, only the OTC transaction has the risk?
Yes, because if it is again exchange traded, then you take the exchange risk of the exchange. We consider it is guaranteed. So no, we assume no risk like in a futures transaction.
So usually, mostly options are traded in OTC, you know.
That was the practice. Now in the global markets, the trends are changing now. There are a lot of derivatives or sorry, options trading in exchanges as well.
The other thing is, in case of rating downgrading, is there any option for the buyer or the buyer of that security to minimize risk?
Yes, if you can remember credit default swaps, that's one way of mitigating that risk. If you have bought a credit default swap and in that contract, if you have defined a credit rating downgrade as the credit event, then you can make the claim. Or you can buy credit options.
Okay, sir. Thank you.
Okay, then we can discuss about the different exposures coming from different sources. So the first one is the simplest one, direct and fixed. The exposure is direct, very clear, and it is fixed. If we go back to these bonds or money market instruments, in a bond, you know what is the face value, maturity value that you are supposed to get from the issuer. So basically that is fixed. It won't vary. If you grant a loan, you know what is the amount of that loan. So from lending to borrower, the exposure is very direct and fixed, but maybe you can consider the exposure slightly changes with the time. From one payment, say for a bond, there are coupon payments. So during the coupon period, you should accrue that interest to your exposure, because if it is a default, you lose that accrual amount as well. So from one coupon payment to the other coupon payment, there will be a slight increase in exposure due to this coupon accruals. But again, once the payment is made, that will fall down to the level equals to the principal amount or the face value of the bond. But basically, it is direct. We can easily calculate it, and we know that amount is fixed. The second type of exposure is variable exposures. As I explained in the previous slide, interest rate swaps or the cross currency swap forwards, when the price of the underlying asset change or the variable changes, value of the derivative changes. So the profit can move from one party to other party. So therefore the exposure would change. Positive exposure may become a negative exposure. So today one party A takes the credit risk, tomorrow party B takes the credit risk. So that can happen, exposure switch from one party to another party. So it is variable exposures mainly coming from OTC derivatives. When we have exposures on certain moves like interest rates, exchange rates, or commodity prices, things like that. As I mentioned, futures are generally ignored due to clear existence of clearinghouse. We settle the transactions through clearinghouse, and we assume clearinghouse will never default. That's an assumption. Then the third exposure type is commitments. You don't have the exposure now, but in future you may get into the exposure due to commitments that you have made. You may have granted a credit line. Depending on how much of that line the borrower has withdrawn, you face the risk. Sometimes your current exposure may be zero. Sometimes you may have large exposures. So depending on the commitments that you have given and the amount withdrawn by the other party, again the amount will vary. So then, in general, how do you evaluate credit
So
risk?
excuse me, sir.
Yes.
In case of credit lines, that exposure occurs only if that other party uses that facility. Right?
Yes. Otherwise, there's no exposure.
Okay.
You might have granted the credit line, but the other party has not used it yet. So then, therefore, no exposure. Then, how do we evaluate this credit risk? You might have learned a lot of things. Just tell me what do you know about how to evaluate credit risk before I discuss these things.
The ratings, sir?
Ratings. You use ratings to evaluate or assess the credit risk of the other party. Yes. What else?
In terms of loans, any facilities that trip report like that?
Yes. Trip reports.
Fast track record?
Fast track records.
If the terms of the
Fast track records of what?
Repayment.
Repayments. Okay.
so if it is a sort of a security, the terms, if they are too attractive, then you can be a bit cautious of
That is also true. Yes. If
And
it is a
duration?
security, you have to go through the covenant and find out whether there are loopholes, or on the other hand, you may have to be cautious if it is too attractive. That is also true.
Duration?
The period, yes. Maturity
Yes.
period, yes.
So type of the product,
Type of the product. What do you mean by that?
that is treasury bill, bond or debenture, something like that.
What else?
Any underwritings like that, sir?
Yes. Any underwritings? Underwritings for what?
Credit lines like that, refinance, availability of refinance.
Okay. Let me. Can you make it more clear? Underwritings, refinance. So there's a borrower and the bank. What do you mean by refinancing?
In some agreements, that person who refinance the facilities undertake the repayment if any defaults in certain extent.
So you mean there's a third party?
Third party, yes.
So he is underwriting.
It's like a credit guarantee schemes.
It's a sort of a guarantee scheme. Yes. If the borrower defaults, the guarantor agrees to
Yes.
pay.
Especially in export financing.
Export financing. Yes. What else? Not only that, no, you take guarantors in personal loans as well.
Yes. The collaterals.
Yes. What else?
Repayment capacity of the borrower, that is for the credit facilities.
Repayment capacity of the borrower. Mhm. Yes, you might have discussed these same things in different jargons and different ways. Maybe I think in credit you might have learned about 5 C's or something like that. So basically, what you explain, yes, we do all those things. But if we put it in a formal way, first thing is we have to evaluate the capacity and willingness, or the ability and willingness. What is capacity? What does it mean by capacity?
You have to have the proper source of income.
Yes, whether they have proper, or the borrower has a proper source of income,
And
or
also
the
that legal capacity to borrow.
legal capacity to borrow. That is very important, especially when you lend to government institutions or provincial council and state governments like that. Whether they have the capacity to borrow. That's the very first thing that from legal side that you have to think about. But when it comes to credit side, capacity, whether the borrower will have a future income or assets enabling him to pay this debt. So that capacity should be evaluated. What is willingness?
It's like a not a willful defaulter.
It's like a
Not a willful defaulter.
not a willful
Default.
default. If you can explain it a bit.
That at the beginning, that when you are doing a credit evaluation, you should ensure that customer has willingness to pay. That means customer is not a defaulter, and customer having a capacity. Though
Yes.
customer having a capacity, if he or she doesn't has any willingness to pay, it's a separate issue. That there is a credit risk involved with that facility.
Okay. In any other explanation?
Sometimes even the borrower may have the capacity to pay, he will not pay due to changes in the market, or may due to some other reason.
Yes. Basically, capacity tells us whether he has, or the borrower has money to pay. But we have seen, so even maybe we may face in day-to-day life as well. You may have some friends, so they'll tell you, maybe they'll borrow maybe few thousands or few hundred rupees, but because by the time he borrows that money, he doesn't have for whatever emergency reason or whatever. But definitely that amount is not a big amount. He can pay, he or she can pay that next day or within 2-3 days, but they don't pay it back. It's not the capacity, that's the willingness. So even though they have money, they are not not going to pay it. Even in the large scale, that can happen. As a habit, they don't pay their debt. So that kind of thing is measured or considered as willingness, whether this person or the entity is willing to pay this. So that now, so you have to evaluate that as well. In that only you have to think about or consider prepayment. Whether this party or the entity has defaulted at a time where that party had the capacity but still defaulted, or the party did not have the capacity and defaulted. They're two different things. So that's why even when you check the CRIB report, just because of a default, you can't consider it as a bad party. So then you may have to see what has happened, whether it's a willingly default or unwillingly, so without the capacity due to other reasons. So that both you have to consider, but you should be extra cautious when the party has defaulted, when the capacity is there. So that is capacity and willingness. Then the external environment. What would be the circumstances, whether there will be any effect on the borrower's capacity or the willingness to pay, that you have to think about. Now, what is your appetite to grant a loan to a tourism sector or something related that? You have to think what is the current environment, what is the situation, or will you grant any credit to importers now? So that you have to think. That again, external environment can affect the capacity as well as the willingness. So need to assess that in the credit evaluation. The next one is, as someone of you mentioned, what is the instrument, what is the nature of the credit facility. If it is just a loan, personal loan, or if it is a bond or a debenture, whether it's a government bond or a debenture, corporate bond, whether it's a repo transaction, all those things has to be considered. In a repo transaction, what is the specialty? What are the characteristics of a repo transaction from the credit evaluation perspective?
That haircut, sir?
Before it comes to haircut, on what do you have the haircut? What's the basic?
Security.
Yeah, collateral. You have the collateral in a report. If you take a mortgage, you have the collateral. So as someone mentioned, whether there is any any underwriting or things like that comes under quality and adequacy of risk mitigants. However, in the characteristics also, you have to think about whether they are underwriters, whether they are guarantors, whether there's any collateral or security pledge with this facility. What is the agreement? If it is a bond, what is the seniority? Whether it get priority over other debts or not. All those things has to be considered in the from the instrument side. What are the characteristics of that instrument itself? Then the next step, you go to the quality and adequacy of risk mitigants. That where you get the haircut in a repo transaction. So repo transaction, the collateral is a risk mitigant. To mitigate the risk, you take the collateral. Then whether the collaterals those securities are in good quality. That you have to think. The guarantor, is it a good guarantor? The mortgage, the land, or the house, or the building, is it in good quality? Is it worth? Will it cover your exposure? So that's why in a repo transaction you get the haircut to have more value than the amount that you lend. Even in a mortgage, there's a loan to value ratio. What is the loan that grant based on the value of the collateral? So that quality and the adequacy of these risk mitigants. What does it mean by risk mitigants? Securities that you take, underwriting, or the guarantors, or other sort of collaterals that you have to assess. What are the qualities? What are the adequate? So when you have a guarantor, you may focus the analysis towards the guarantor than the borrower. That can happen. That may, because ultimately, if the borrower defaults, you will turn towards the guarantor. So the guarantor should be able to pay you back. Those things are important in credit risk evaluation. As I mentioned, all those things you might have heard in different words, different jargons, different way, but these are the basic of evaluation. In the evaluation, there can be qualitative techniques and the quantitative techniques.
So excuse me, sir.
Yes.
In case of that repo transaction, is there a haircut rule? That means the limit which lend to a certain percentage by
Yes.
central bank?
Yes, there's a haircut regulation issued by the non-bank finance department for all the participants in the market. Especially, they said it's for the direct participants. But once you establish for direct participant, it will be applicable for all the participants as well.
So usually that is how much percentage?
That varies from with the from 4% to 12%, depending on the maturity period of the remaining maturity of the collateral. Remaining maturity of the collateral, not the remaining maturity of the repo transaction. There's the direction number 1 of 2019, I guess, if I remember it correctly.
So that means they keep a margin of 4 to 12%, is it?
Sorry?
Do they keep a charge percentage of 4 to 12%?
Yes.
And the rest is lending.
According to the guideline, you have to do that.
Oops.
So qualitative techniques, as I mentioned, what we discuss here, ability and willingness. So the capacity and willingness. Capacity, you have some numbers. What is the income? What is the cash flow? Things like that. Willingness, you cannot get it through numbers. So largely, willingness is evaluated through qualitative techniques. You may interview the borrower or find out some other ways of evaluating the character and the history. So in the qualitative techniques, you gather information about the borrower, historical information, whether he has defaulted or not, how is there any bad impression about the borrower, whether there's such record, if it is a corporate, what is the corporate governance of that entity and things like that. And you may have a face-to-face meeting to assess or identify the characteristics of the borrower and make a judgment. In some cases nowadays is very limited, name lending. If the borrower is very known and you know the borrower, you can you have good relationship, so you may lend without any hesitant. So that is name lending. And the last thing, as I mentioned, you get the past information and you extrapolate it to the future and assuming that what the behavior in the past will continue into the future. So these are very generic things that you might have learned in any other courses. In the quantitative techniques, we largely used to evaluate the borrower's ability to repay, whether the borrower has the capacity to repay. So therefore, the attributes are very objective and very clear. But there can be limitations. Again, say if you do analysis on the financial statements, historical financial statements, to see what is the cash flow, what is the profit, what is the turnover, what is the leverage, or things like that. Again, we assume that will prevail in the future as well. That's a sort of a limitation. Then sometimes even in financial statements, the numbers different people may interpret in different ways. There can be ways of reporting, though there are standards, accounting standards. There are some flexibility to given to the entity in the way they report. So the analyst should be able to identify those things, what are the variations they have done, whether it's done in the proper way, and or from your analysis perspective, you may need to adjust it into the other method. So say operational leases or capital lease. There's a very thin margin, very difficult to, or in some instances, it's very difficult to categorize whether this is operational lease or a capital. So depending on your analysis and your objective, you may change it the way they have reported. So all those things are there in when you do the quantitative techniques, even though ultimately you can come up with a number or some measure. Again, it is not an easy task. And again, that one also or the in as a whole, credit risk management, I would say it's a art rather than a science. You have techniques, tools, mathematical models and things, but you need some qualitative assessments and come to a judgment. So therefore, the best way to combine both quantitative techniques and the qualitative techniques and come up with the evaluation, that would be the best. So therefore, it can be considered as an art rather than a science. So then the types of borrowers, why do I take this here? So consumers, we are not going to discuss consumer side in this course. We mostly focus on the other three: corporations, financial institutions, governments or government related entities. I'll give a brief comparison. What are the things that you have to pay attention or give focus when you evaluate a corporation or a financial institution and a government. So I don't think you need any explanation on this classification on borrowers, consumers, corporations, financial institutions, and governments. But one thing I have to explain: corporations. What is the difference between corporations and financial institutions? Why do we segregate those? Can someone explain whether there's any difference, or why don't we consider all these as corporations, private firms, or private entities?
So risk of financial institution is higher, maybe higher, that depending on the nature of business.
Yes, in a way, yes. Even though it's a private entity or corporate, corporations, what we have classified here as corporations, they do some services or goods in the real sector. So they produce something or they give some service or something like that. But in the financial institutions, they provide the financial service. They borrow money, they lend money, and their business is completely different from corporations. And so therefore, we have segregated that corporations and financial institutions. Anything else? Any questions? So this is a small comparison for different type of borrowers. How do we evaluate what we discussed earlier? Capacity and willingness, characteristics, or things like that. So I dropped the consumers. I'm not going to discuss that. In a corporate, you will assess what is the liquidity available for that corporate. What are the cash flows in future? You will carry out a cash flow analysis. What is the earning capacity? What is the profitability? What is the amount of capital? What how would that variables profit or the capital position, earnings will have an impact depending on the state of the economy and in which sector, what is the industry that corporation is operated, whether it's in the agricultural sector or any other construction sector or pharmaceutical or the health sector or educational sector. All those things will be considered. So lot of variables. You do a lot of analysis with their financial statements, business proposals, what are the new ventures they are going to do, all those things. When it comes to financial institutions, FIs means financial institutions, the most important thing is liquidity. Even though even in corporations we measure the liquidity, we pay more attention on liquidity when it comes to the financial institution, because we know if the financial institution cannot meet the liquidity, that would become the end of the institution. That will be a run on the institution, and that's the end. So therefore, the liquidity is very important in a financial institution. Then we check the capital position as well, whether they have the ability to absorb any loss. What is the capital compared to maybe risk-weighted assets or things like that? What is the capital? Whether this financial institution has the ability to absorb such a loss. Even in corporations we check those, we may pay more attention to those variables in the financial institutions. Then we check the historical performance of the financial institution, how they have evolved, whether they are doing well or doing bad in the recent history. And then we'll check what are the assets held by financial institution and what is the quality of those assets. If they have, if the financial institutions is holding very good quality assets, then then we can be sure that in a stress situation or a bad situation, they can liquidate those assets and generate liquidity and meet the requirement. So it won't be a problem. But if the most of the assets are in bad shape, bad quality, the assets are not performing well, does not provide the adequate cash flow and things like that, that will give you a different picture. Then the state of the economy, that matters to the financial institutions as well. But even though it's not mentioned here, financial, when you do evaluate a financial institution and asset quality, you have to think about, so where does this institution hold these assets? Because if every assets in a, or have high concentration into a single industry, then that would be a problem. Whether the asset portfolio is diversified, whether there's any specialty towards some industry. You might see there are some banks or financial institutions, they prefer to lend to agricultural sector. Some maybe prefer to lend to energy sector, or some may prefer to lend to a education sector or health sector or the consumer products likewise. So you have to think about all those things, because if something goes wrong in one industry, that may have a major impact on the financial institution as well. So therefore that diversification or the exposure to different industries has to be considered when you evaluate financial institutions. Not only the quality of the assets, but where are they, what is the business module of the financial institution. When it comes to sovereign or the government, it's sort of completely different picture, especially when you evaluate a country, you have to think about the amount of external debt. That means the government borrowings from outside the country in other currencies. That is a key. Then the total debt relative to the overall economy. In simple terms, if we take debt to GDP ratio, what is the amount of debt compared to the GDP of that country? That gives an indication. In general, it says more than 100 is not good, but there are countries having debt to GDP ratios maybe 120 or something like that for a long period. So that also again relative, depends what kind of economy you are, what kind of a country you are, and things like that. Then on the other side, as we evaluate in a corporation or a financial institution, what are the incomes for a sovereign? What is the main income for the sovereign? It is the tax collection. So therefore, when you evaluate a country, you have to think about the tax revenue of that government, whether you have a good tax base, tax income, and maybe what is the ratio of that tax income and the debt, whether the tax income is sufficient to pay this debt. If not, what are the other mechanisms or the sources available, whether the country can go to the market and borrow at a reasonable rate. Those things has to be considered when you evaluate a sovereign. So you can see it's completely different from evaluating a other corporation or a financial institution when it comes to the evaluation of capacity. When it comes to evaluation of willingness for corporations, mainly we have to think about the quality of the management, governance structure of the management, whether the management is good, management of the firm or the corporate is good, and how they have served their debt in the history. Almost same applies for the evaluation of financial institutions with regard to willingness. Again, we have to think about the quality of management, what is the structure of the board and other committees and things like that, who are the people sitting on these committees, their past patterns, behaviors, and other qualitative analysis what we discussed earlier. But when it comes to sovereign, again, it is mostly it's very subjective because it's the government. But only thing is we have to consider about the legal system. What is the legal system in that country, whether we can enforce any rights of the creditors and recover the funds. So in global there's a rank. So if you are at the top of the ranking, legal system ranking, it is considered as low risk or good quality. But whenever you go down the ranking, it is considered as it is high risky or bad. So when we evaluate corporations and fixed financial institutions, we consider quality of management and the other historical aspects and the other qualitative analysis. But when it comes to sovereign, mostly it's a very subjective area than the others. Legal system and the ability to enforce that rights has to be considered. Then the methods. What are the methods that we use to analyze? In the corporate, you may do detailed analysis in financial statements and their proposals, business models, all those things. You may do interview, very complex analysis, and you can do almost the same thing in the financial institutions, for the financial institutions as well. But only thing is your focus may be slightly vary depending on what are the variables you look at. In a financial institutions, your focus would be to assess the liquidity, capital base, and quality of assets. But in a corporation, it may be, yes, you may look at the liquidity, but not as much as like in a financial institution. But in a corporation, you may focus on the business module, what is the industry, what are the prospects of that business and things like that. But it may be different in the financial institutions. Sovereign also same, you have to do a very deep analysis, in-depth analysis, but most of the things are again subjective analysis, and you have to consider the political environment of the country as well.
In case of excuse me, sir, in case of that willingness to pay by the sovereigns, even though that legal system of that country won't allow to proceed with any legal enforcement, we can get the help. Anyone who borrows from that country or lend that to that country can seek the help of that international court, no?
Yeah, that depends. Yes. Yeah, that depends on the that's what you have to consider all those things. What is the ability to go for that sort of things, but it may be limited if you issue the bond or things and saying that governing law is local, then there's a problem. There can be, but if it is an international bond and the governing law is international law or a US law or UK law, then it's a different story. So you have to consider all those things. Yes.
Okay, sir.
So the primary difference, as I mentioned, between a corporate and the financial firm analysis, for a financial firm, the liquidity and the quality of the assets, because quality of assets will improve the liquidity as well. Go hand in hand. When you have good quality asset, you may be able to sell some of them, even though those are not possible to sell. It will give you the proper cash flow or the liquidity to meet your obligation. If the assets are not performing, then the financial institution face liquidity problem. So therefore, the quality of assets is very important when you analyze a financial firm. But when you compare it with a corporate, you may mainly focus on the cash flow. What are the cash flow generated through their operation? Because that will give you the capacity to repay. So remember, profit and cash flow is two different things. Even though the firm is showing good profit, there may not be a cash flow. If the cash flow is not there, the corporate cannot repay its debt. So therefore, you have to pay attention to the cash flow. Then what are the quantitative measures that we can use? Some of the measures we can use to measure the credit risk. Some of them we slightly discussed earlier. One thing is probability of default. What is the chance of a borrower defaulting? What is that chance? Then the loss given default. What does it mean? If a loss happens, if a default event happens, what would be the loss to us? That loss will depend on the exposure you have had towards that defaulted party. And then considering these three variables, we can calculate the expected loss. What would be the loss that we expect from a particular party, or maybe from a total credit portfolio? So I'll briefly go through these each of these variables. Probability of default, as I mentioned, what is the chance, likelihood of a default by a particular party? Generally, we calculate the probability as a ratio or dividing by these two. Number of borrowers defaulted divided by the number of borrowers you had. Say you had 10,000 borrowers, 5 was defaulted, then 5 divided by 10,000 within a period, say within a 1 year period. Generally, probability of default is measured for a 1 year period. This is the basic definition, but this you can break into or devise it into different ways. Say you have credit ratings. you want to see what is the chance of default in a AAA party, what is the chance of default in a by a BBB party, likewise. So then what you have to do, consider what is the total number of borrowers in AAA. Out of that AAA parties, how many had defaulted in the previous year or in previous years. Then that ratio will give you probability of default for a AAA party. The same thing can be done for any other rating category, not only ratings. You may consider industry. What is the probability of default for a particular industry or particular country, or whatever classification you need, you can use it or measure it. But only thing is you need some historical data, which is a big problem. Whether you have good quality data to assess this probability of default, because you should not consider only your borrowers, what is in your books. It will be biased. You have to think about the whole market, whole participants, and consider that. But the good thing is, for rating agencies, they have published a default probabilities. Not only default probabilities, they publish transition probabilities as well. What does it mean by a transition probability? AAA party today, what is the probability will end up as a AA plus party within a 1 year period? AAA party moving from AAA to AA plus, the next category of rating, what is the probability? It shows from one category to all other categories, what are the probabilities. So you can use those, but again, the thing is, the rating agencies, they provide numbers based on the international market experiences and based on those information. But then when we use, if you have to use those figures in the local context, we have to think about it and see whether those figures are appropriate for our borrowers or to Sri Lanka. So that that's about probability of default. Then the loss given default, as this is expressed as a percentage generally. What would be the amount, or the, sorry, not the amount, what is the portion that we may lose if a default event happens? In a other way, what is the portion we recover? 1 minus that is the portion that we are going to lose. So recovery rate is the opposite of the loss given default. So how much is recoverable, again as a percentage. So therefore recovery rate equals to 1 minus loss given default. If you have 100 exposure to a party, what is the percentage that you will be able to recover after all the proceedings in a default event? Whether you will be able to recover 90% of that or 10% of that or 25%.
It depends on the security also, no, sir?
That depends on the security, nature of the product. So all the characteristics what we discussed, that and the legal barriers, all those things. Again, better to come up with historical analysis and have some estimates on those things. Say yes, if you have a collateral and the market value is with a haircut requirement, if you are sure that the market value of the collateral is much higher than what is your exposure, then even after liquidation and after the other expenses, your recovery rate may be 100%. But if the collateral is not that good, your recovery rate may be low. So all those things what we discuss, we have to think. Not only that, then what are the agreements that we have with the party, whether you agree to net the transaction or without, or settlement of gross basis, all those things will matter here. Then the exposure at default, it measures in rupee amounts or the absolute amount. What is the amount that you are expecting from that defaulted party? It may be the whole loan amount, or it may be part of the whole part of the loan amount, because you have recovered some of the loan by the time the default event happened. So you can define it in different ways. The last one, the exposure at default, you can consider it as what is the loss that you may incur if you cannot recover anything. Your recovery rate is 0. What is the loss? That's the exposure at default. You can think in that as well. What is the amount that say you have granted 10,000, you have given 10,000 one of your friend, he is not paying, but he is paying 1,000 rupees, 500 rupees likewise, and you know he may do that only up maybe 5-6 months, then nothing will pay. So the exposure is 10,000, but your recovery may be 4,000, 5,000. Likewise, even in the financial markets, wholesale market, these things can apply. Any moment, what is the exposure towards a party? That measure should be available for the lender. So I'll go through different exposure profiles for different products, as I mentioned earlier as well. Say for a bond, exposure may be mostly fixed and very clear, but fixed. As I mentioned earlier, so generally the 100 pi is the exposure you have. At time 0, the moment you buy the bond, your exposure is face value. But with the time, you accrue interest income on that. So until the next coupon payment, your exposure gradually increase up to the level of face value plus coupon. The moment the borrower or the issuer of the bond pays that coupon, your exposure will fall down back to the face value 100. So likewise, this is a 10-year bond with semi-annual coupon. No, sorry, with annual coupons. So you can see during the first year, your exposure increases gradually. Then at the end of the first year, again, it will drop back to 100. That means the face value, because the coupon is paid. That's the pattern. But after 10 years, what would happen? On this date, borrower pays everything, then your exposure drops to 0. You don't have any more exposure towards that borrower or the issuer. That is the credit exposure profile of a bond. Is it clear? This is very straightforward, very clear, very easy to understand.
Mr. Nishanta,
Yes.
what does are there a term called par value of the bond?
Yes, par value means the face value.
The face value.
Yes. 400. Par means 100. Above par, below par. Above par means the price is above 100. Below par means the price is below 100. Trading at a discount or a trading at a premium.
Premium. No.
Yes. Yes. So then for an amortized loan, how this exposure changes. In an amortized loan, you know, in a single payment, there will be an interest component as well as part of the principal. So assume the value is 100. Until the first payment, you accrue the interest, and the moment the first installment is paid, it will drop below the original principal value as well, because the first installment includes part of the capital interest amount, and the part of capital is paid, so the value drops below the principal amount. Likewise, in every installment, the exposure reduces and again increase slightly up with the interest accrual, again drops back. On the maturity date, again it will be 0. So towards the end, you can see the exposure is less. But in a bond, right, it remains almost same during the lifetime of the bond. But in amortized loan, exposure reduces with the time due to capital payments with the monthly or annual, whatever the installment. Effect forward. Can someone explain why this is upward sloping? At the beginning, we know that there's no exposure. The product is priced in a manner that no one has the profit or loss. But with the time, you may get the exposure and increase it, because there's a you are getting closer to maturity. On the maturity date, what happens? During any in between the life period of the forward contract, any default, you get only the mark-to-market exposure. But on the maturity, you get the full exposure. That's why it increases with the time. But again, once the trade is settled, it drops back to 0. On the settlement date, it is at the maximum level because of the settlement risk. But in the future, it won't happen. You always do mark to market and margin placements, so there's no risk. So few profiles, you can think about how would this change for a option or any other product that you can think about. But when it comes to deposits and repos,
Sir, sir, why is that increasing, sir? That forward
because with the time you accruals goes up in a forward. And you are getting closer to the maturity, you get the full exposure on the maturity.
So anytime that the amount is same, doesn't it? So at a given time, so if other party is,
No, but other changes in variables, mark to market, and things like that would change. It's not the principal amount. Principal amount would come at the end on this date only. Because if you default somewhere here or the party default somewhere here, you don't face that. You don't lose that principal. You have not paid. You have your money with you. You don't face that full amount. It will be only on the maturity date. That's why it's peak at that level.
So this curve purely reflects the valuation.
Yes. Until this. When it comes to deposits, you don't do mark to market.
yeah, excuse me, sir, I didn't understand that. Sorry. In the case of that forward exit transaction, we let's say we export agrees to sell his foreign currency for 3 months. So if that the let's say in other case it is the bank who goes to buy the dollars. So the exposure remains same, no, sir.
How?
The bank, so let's
Okay.
say bank defaults, so that is the risk of the credit risk. No?
If bank defaults, do you lose anything? What do you lose? In a forward transaction, before maturity date, if the bank goes or your counterparty goes bankrupt, what do you lose?
Okay, we do not lose anything. However, so
you don't lose anything. Your exposure is not that much, but only the difference is that's the replacement cost. What we call it replacement cost. So what would happen? Market might have moved. So that is the amount you are putting into risk. So you can enter into a new transaction. By that time, if the market has moved, that's the only exposure or the loss you may incur. You don't lose the principal amount. But on the settlement date, you pay your dues. If the counterparty does not pay its due, then you lose the whole principal amount, the settlement risk. So that's why on the settlement date, your exposure is at the peak.
This increases because that movement in the market.
Interest rates changes, spot changes, all those things.
Then because of that, the other party may withdraw from the country. That's the risk.
That's
Because of that risk.
Yes.
Okay, sir.
So when it comes to deposits, we don't do any mark to market or anything. So basically the exposure is constant, the amount of the deposit, but if you want really, you can do a small adjustment with the accrued interest, like in a bond. Then this will increase with the time slightly depending on the interest accrual. But in the repo, you have the collateral, but you have given the funds in a reverse repo. So only the difference, if there's any difference, that you get the exposure. So therefore, if there's any exposure, it would be very small compared to the notional amount. It is very small, and even that one may be negative if you have more additional collaterals. Value of the collateral is higher than the amount that you lend. Then the exposure is negative. That can happen even if there's a exposure positive, it will be very small and it will short-lived, because next day you can ask them to replenish collateral depending on the collateral agreement, and it will top up, then the exposure vanishes. Interest rate swaps, it's a derivative exposure, as I discussed earlier. This is very difficult to quantify. Depending on the market movements, it will swing here and there. Then we need to have models to determine the potential exposure in the future. Current exposure, we can measure it straight away, but the potential exposure, it would be difficult. However, if there's any principal payment involved on the maturity date, that would be the highest point of the exposure for an interest rate swap or a currency swap. So once we have these first three variables, probability of default, loss given default, and exposure of default, the expected loss is calculated as the probability of default into exposure default and the loss given default. So once you have these assessments, you know what is the loss that you expect due to a credit event, not due to any market events, but due to credit events. However, even in the credit events, there can be links with the market risks. That link is there. So yeah, when you do evaluating, you may have to think about those as well, the correlation between market and credit risk. So this expected loss can be calculated for an individual position or as the whole credit portfolio. So if you add expected loss of each and every portion, that will give you the total expected loss. It doesn't matter. But when it comes to the unexpected loss, that means actual loss realized, which we may know, but there are ways of quantifying this unexpected loss with the probability of default, exposure at default, and loss given default. I'm not going to explain that methods. It involves again few statistical calculation where you consider. So basically what you are going to do, you calculate the variance of this possible loss. What would be the distribution? The loss can be any amount. Expected loss is the average of that. But to calculate the unexpected loss, what we do, we get the whole distribution and calculate the standard deviation and take the difference between that standard deviation figure and the loss amount and the expected loss as the unexpected loss. So I'm not going to discuss that. It will be too much for you. However, when we calculate the unexpected loss, especially since we are calculating the standard deviation, then the dependency of different positions you have, say, if a one party fails, defaulted, is there any high risk for another party also to fail or default? That relationship can be there. That correlation is considered when we calculate the unexpected loss. So I think this is a duplication, so we can skip that. Then when you monitor the market or the credit risk, other measure that you can use is, or way that you can use is market signals. what are the signals given by the market. Whenever there is a credit default swap is traded on an entity, you can monitor that. You can monitor whether the spread is widening or shrinking. If the spread widens, that gives you some indication market participants expect a high credit risk of that reference entity. So that will give you some indication, because you can't calculate the probability of default each and every day, but there are ways, or there are some more other models to use this credit default swaps and calculate the probability of default and things. Again, I'm not going to discuss those models. That's why I mentioned, if you are to discuss this will be a completely another diploma. So, but you have some idea about these things, and try to learn more if you really interested. The first one is the market signal is the credit default swap, whether the swap spread widens. But some entities there may not be any CDS, but there may be bonds. Then watch the bond spreads. That means compared to maybe a peer for the same industry, same category, what is the yield of the bond and what is the yield of a peer group bond, or maybe compared to the same maturity government bonds. If that spread widens again, that means yield increases. Yield can increase both government security and the specific bond, but the thing is, if that gap widens, the spread widens, that will give you some indication that the credit risk is increasing. If that gap narrows, then it's an improvement of credit risk. The other variable that you can monitor is the equity prices. Though you don't invest in equities, monitor equity prices of the firm, because if the market is having some information and they foresee the future, they will react. So these are leading indicators. Equity price is a leading indicator. It will give you about an indication about where's the economy is heading and where's a particular entity is heading. So if the equity prices change drastically or a drastic drop, that gives you some indication, something wrong with that part. Then other financial indicators in the balance sheet or other financial statements, but these indicators may not vary daily basis or very frequently. That depends on how frequently they publish their financial statements. So depending on that, this frequency, availability of this information vary, but generally CDS, bond spreads and equity prices are generally daily available. So we have to pay attention to the market signals, and if you see something, then you have to dig into that and see whether what is the real reason. The drop in equity prices, it doesn't say that the party is going to default, but it indicates some problem is there. Then you have to investigate what it is, find out what it is, and what would be the impact on the credit. That analysis, further analysis is required. These are only signals or indicators. So that's about basic credit risk management. So after the break, I'll move into the counterparty credit. How do we can measure counterparty credit? Again, I'll give you only a brief or an overview of that side. Any questions? Any questions?
Sir, excuse me, can you explain that CDS as a signal swap, credit default swap? How do you use that?
What is a CDS? So credit default swap. There's a premium that you have to pay to buy the credit default swap. That is the spread that we call. If that widens, what does it indicate? The reference entity credit quality is deteriorating, so it's going down. So that's why protection seller need more premium.
So it is available in the market every day?
Not all for all entities there are credit default swaps, but for some entities there are credit default swap products. But in Sri Lanka we don't have any market for the credit default swaps. None of our entities, Sri Lankan entities, have. Or there's no party to sell credit default swaps, or there's no party to buy as maybe because of there are no sellers, there are no buyers, or both. Market is not that developed. It's a long way for us to go.
The bond spread also, that is as an indicator, it is not available, no, in Sri Lanka.
But
bond spread indicators.
Bond spreads, again, the thing is, if the corporate bonds are not liquid, there's no secondary market, then it won't work. If the bonds are actively trading only, you can find the current yield and calculate the spread.
Okay, sir, thank you. So in the other case, to calculate unexpected loss, we have to calculate expected loss, no? After
yes,
that
yes. You need expected loss, then calculate the standard deviation, and it's like sort of calculation of VaR.
Okay, sir, thank you.
If you don't have any questions, shall we take a break of about 15 minutes? Now it's 10:45, say 10:45. Shall we come back 11 o'clock? When we consider credit risk, so we can have a lot of categories, as I mentioned earlier. But in a treasury, basically you will face a counterparty credit risk. What does it mean by counterparty? When you enter into a transaction, the party in the opposite side is the counterparty. So basically, when we consider counterparties, sometimes even issuers may not be considered as counterparty because it's clearly purely lending business. You are buying a bond is a sort of a lending, but you do transactions, basically derivative transactions or outright purchase sales transactions. The party who you face is the counterparty, and still there can be a credit risk with that counterparties. It is managed through this counterparty credit risk management. What is counterparty credit risk? It is the risk that a loss due to a counterparty defaulting before the maturity of one or more transactions. So see here, it's the maturity of one or more transactions. So and the counterparty, it is not the borrower or the lender or something like that. The counterparty, the opposite party in your transaction. It's a basically, as I mentioned, it's a form of credit risk. But as I mentioned, it's slightly different from the other forms of credit risk, what we generally discuss so far. And the risk of this counterparty credit risk, there will be links with market risk as well, because in the counterparty credit risk, there's no way that we can say only one party has the exposure. It can be either party. So that's the major difference here. In general credit risk, one party takes the credit risk of the other party, but in a counterparty credit risk, at a particular time, a point of time, only one party takes the credit risk of other party, but it may swing here and there or switch between two parties. So therefore, it is the counterparty credit risk is faced by either party, and risk change over time. As we discussed, with the time, risk it may give a risk, or it may be the risk to the other party. That change, and the amount also changes when the market movements changes. That's why it says more akin to market risk. There's a link with market risk. With the market movements, credit risk also, counterparty credit risk also changes. And some instances, exposure can be zero, no exposure to the counterparty, it is zero. That can also happen. But so that generally you can say exposure could be zero. So when you don't have any any transaction or any lending, then exposure is zero. That's true. But here it's not what it is meant. Even though you have a transaction with the other party, exposure may be zero. That is the key here. So just to explain this, I think this was discussed in the previous one as well. If you consider term loan and the interest rate swap, what are the characteristics? If it is a term loan, what is the risk, credit risk? In a term loan, what is the credit risk? Can someone explain? What is the credit risk of a term loan?
The risk that arises due to the non-payment of by the borrower.
It's not that risk due to the payment, it's due to the non-payment. The borrower may not pay the loan amount on time. And the key here is the amount is fixed. Interest component may not be fixed. That depends on the agreement. If it is a floating rate type of term loan, then the interest component may vary with the time. But assuming it's a fixed rate, then generally in a term loan it's a fixed rate. So you know what are the cash flows or the obligation dates, time in, and the payment amount that is fixed. That's what we discussed in the morning session. So it's a straightforward thing, fixed and direct. But when it comes to interest rate swap, when the interest rate changes, the party who should pay changes. In the interest rate swap, one part, say fixed float agreement, one party agrees to pay fixed, other party agrees to pay float. If the on the fixing date, if the fixed rate is higher than the floating rate, then fixed payer has to pay to the floating payer. Then the floating payer takes the credit risk of the fixed payer, because the floating payer expect a cash flow from the fixed payer. But with the time, this relationship can move other way around. That is, fixed rate is less than the floating rate. Then the floating rate payer should pay to the fixed rate payer. That will give a exposure or credit risk to the fixed payer on the floating payer. Fixed payer takes the credit risk of the floating payer. So it changes with the time due to the changes in market variables. And what about the amount? Even though the notional amount is fixed, we never know what would be the difference between fixed rate and the floating rate. It will changes every day. Depending on that, the exposure amount also changes every day. So that is the most difficulty in counterparty risk exposure. It's not like in a term loan, in a interest rates of type of a thing. As it mentioned here, either party could be exposed. Risks change over time, or it may be zero. If the both interest rates are same, then the exposure is zero. No one is owes anything to the other party. So that can happen. Then the other variable that we have to think, which is not clear, or we don't know, when would be the default event occur, timing of the default. That is also important. This is something what we discussed. If the default occurs on the settlement date or the maturity date, we may lose some principal amount or some money. That is high. Generally, it is high. That is we call settlement risk. You may remember we discussed when we discuss about we discussed this credit settlement risk when we discuss about foreign exchange related risk. On the settlement date, you pay your currency, whatever your payment currency, and waiting for the other currency to be received. So that leg may not happen. So that's the settlement risk. So you have made the payment, but you have not received the payment due for you. So there's a risk that is high. Your whole principal amount is at a risk if the default occurs on the maturity date. But if it happens prior to the maturity, we call it the pre-settlement risk. What would happen if it happens prior to maturity? During the lifetime of the transaction or the contract, only the mark-to-market gain, if we have, we have in the positive mark-to-market, then we take the credit risk of the other party. If the other party defaults or become non-existent, then we take that loss only. That may be relatively small amount and may not be a real or realized thing depending on the type of the contract. However, you may have to replace the contract, the existing contract, with another party. That means you enter into another new transaction just to fulfill your requirement. Then there will be a cost and the loss amount that is called the replacement cost. So depending on the timing of default, we call them as the settlement risk or the pre-settlement risk. Settlement risk is the if the default occurs on the maturity date, then the risk amount exposure is high, loss could be high. But if it is prior to maturity, it's only a mark-to-market gain. If there's any positive mark to market. If it is negative, again, we don't worry, we are happy. We are on the losing side, so better to go away with that agreement. But if it is a positive mark to market, then we take the risk. We have to enter into a new transaction with unfavorable terms, so we lose something. That replacement cost has to be incurred by ourselves. So transaction with counterparty risk, this is almost the things that we discussed previously. Securities financing transaction. You may buy a security through a or funded with a repo transaction. You buy the security, but to get that cash, you lend that security, give that security away as a collateral and borrow cash. So you can roll over it. That's how you finance your securities position. You leverage your position. So then you take some counterparty credit risk. OTC derivatives, as we discussed in the morning, foreign exchange forwards, we discussed forward how these things could generate counterparty credit risk. But one thing that we didn't discuss is credit default swaps. We may enter into a credit default swap transaction to mitigate the credit risk against another party, against a reference entity. But so if we take this is the reference entity, then we have the protection seller. To eliminate the credit risk of this reference entity, to eliminate the risk of this reference entity, we pay a premium to the protection seller and expect, if this reference entity defaulted, protection seller to compensate us. But what would happen by the time this reference entity goes bankrupt, the protection seller also goes bankrupt. Then we don't get any compensation for this. Not only that, we lost the premium paid to the protection seller as well. So that sort of risk we call is the wrong way risk. So that means basically, if the risk of this party increases, risk of this party also increases, it's not going to work for us. It should be better if it can be other way around. So that's how credit default swap will give us a counterparty credit risk. So the credit exposure, again, as we discussed, the loss that we may incur in the event on the counterparty defaulting. That's why it says conditional on the counterparty defaulting. What would be the loss if the counterparty defaults? What would be the loss if the counterparty defaults? So it may or may not be the full principal amount, depending on the nature of the transaction, what type of transaction that we have, depending on this type of the transaction, whether we get the full principal amount at risk or only part of it or something else. Remember, it's not always the full principal amount is at risk. And when we manage in the counterparty risk, we have to consider not only the current, what is the today's exposure, that is we call current exposure. It's not the only variable that we have to think. we have to think about what would be the future exposure within a 1 year period. After 1 year period, what would be the exposure? By that time, if the counterparty defaulted, what would be the loss for us? What would be the contingent liabilities from that party? Those are the things that we have to consider when we evaluate the credit exposure in evaluating counterparty risk. Then we take some mitigation or credit migration action that will give you a credit risk as well. Credit migration, that is, as we discussed, maybe a default, full default. The party does not pay its obligation, but it may be a soft default. Say for example, credit card. The credit card holder may forget to pay the due on the date, but after 2-3 days, the credit card holder realizes that he misses the payment. He will make the payment, full payment or part payment, whatever it is. But theoretically, on the date itself, it's a default, but within very short time period, it was corrected. That kind of things happen even in the bonds or other products as well. Even in the interest rates of for whatever reason, on the settlement date, payment may not receive. So theoretically it's a default, but you have to think about whether it's a permanent one or it's just a temporary one. That is on the default side. But the credit migration, as I mentioned earlier, AAA party may become a AA party, or a AA party may become a single A party, or straight away transfer to default. The rating change, especially in the towards the negative side, from higher rating to lower rating. That will give us more credit risk. So that is we call credit migration. You may remember during the last year or so, Sri Lanka credit rating of Sri Lanka was lowered from BB+ to CCC, and likewise. So those who have lent money to Sri Lanka, now they face high credit risk because of this credit migration. Likewise, if any party credit rating is downgraded, those who have any exposure to that party get more credit risk towards that party. Then, as we discussed, probability of default, now I don't have to explain this, but even in the counterparty credit risk, we consider probability of default. What would be the chance or the likelihood that the counterparty will default, or it may be probability of transition, credit migration from a AA to BBB, something like that. All those things considered as default probability, and if it increases, our credit risk increases. So if we see deterioration in credit quality of a counterparty, that means that suggests probability of default increase over time. But if we expect any improvement in the party, then the probability of default will decrease, reducing our credit exposure and the credit risk. So recovery, sorry to repetition, just to complete, for the completion I included that recovery is again out of our exposure. What is the proportion that we may recover? It may not be, it may be 100%, or it may be 0%, or it may be in between that. Again, I want to highlight that recovery rate depends on many variables, whether you have guarantee, collateral, what is the value of that collateral, quality of that collateral, whether there's a guarantor or ring fencing. That means there's a set of asset allocated to back this loan. Things like that matters in the recovery, and the priority, whether you get some priority in liquidation process over the other creditors. That everything matters when we decide the recovery rate. Then the mark to market, as we discussed even in previous sessions, what is mark to market. So all the outstanding transaction, we value based on the market prices. What are the market prices today? Then what is the value of the transaction as of today? Then we can see, based on the contractual agreement, what was the initial price, what is the current price. When there is a difference, one party makes a profit, the other party makes a loss. So that is mark to market. We value your position based on the market prices. So you can add them together against a given counterparty. What are the mark to market profits and losses against another counterparty? That will give you the some exposure, or give you the exposure. It represents the current potential loss because it reflects what is the today's position based on the mark to market. So it gives you the current potential loss. If the counterparty defaults today, this is the amount that we are at risk. This much of amount is at risk. Maybe part of it may be recovered or maybe not. Everything will be lost. However, when we do the mark to market, it fails to consider netting, collateral or hedging, what we have done, because it's purely based on the contractual agreement. We do that. Then to have the proper evaluation on the exposure, then we have to consider, okay, this is the mark to market value of the contract. This much of collateral is with us. So therefore, once we net that against the value of the collateral, this is the exposure. Or whether we have done any other transaction to hedge this position, credit risk, whether we have entered into a CDS transaction. If it is, then the exposure may be set off with the profit we gain from the CDS transaction. But mark to market is a measure of replacement cost. That's what I mentioned earlier. If the counterparty fails before the maturity of the transaction, this mark to market amount is the amount that we are at risk. That is the cost that we have to pay to enter into a similar contract with a new party to fulfill our requirement. So that is why we call it the replacement cost. That replacement cost comes due to transaction costs but this replacement cost does not reflect all the costs that we incur, because in the replacement cost it gives us only the mark to market gain or loss. But whenever we go to the market, when we try to do another transaction, then we may have to pay maybe brokerage fees or any other administration fees. Then that cost is there. These are the transaction costs. Not only that, the bid ask spread. You may have to sell something and you may have to buy something. Then that bid ask spread is, you have to pay that bid ask spread. Whereas the mark to market is done only maybe on the mid price or the bid price. So therefore, our actual replacement cost would be slightly higher than the mark to market replacement mark to market value. but it may be low because by the time we go to the market and try to enter into a new transaction, market might have moved our favor. That can happen, or it may be worst. So, however, at the point of time of measuring, mark to market measures the replacement cost approximately, not exactly. How do we manage counterparty risk? How do we mitigate this counterparty risk? The simple way or the rule that we can include is trade only with high quality counterparties. Don't trade with each and every party in the market. Trade only with AAA parties or AA or above, or investment grade parties only, whatever. So depending on your risk tolerance, risk appetite, you will select or draw a line. Okay, we do trade only with these parties, or in a country only with top 5 banks, something like that. Or now there's a classification, systemically important banks. Okay, you can decide, okay, we deal only with systemically important banks, because if something goes wrong, the regulators will help them, because it is too big to fail these parties. So therefore we have the protection. Likewise, for depending on your requirement, your risk appetite, risk tolerance, market conditions, you can decide to trade only with high quality counterparties. Then you monitor only those parties. That's a one way. I'll come to some more details on that later when it comes to credit ratings and limits. Then the other thing is cross product netting. That means you enter into agreement with the counterparty for the settlement. We net all the obligations each other. That means in between two counterparties there can be many transactions in many products. There can be interest rate swap, there can be a currency swap, there can be a FX forward, things like that. So what do you do this in a cross product netting? Okay, I'll move to this and explain. You calculate the mark to market of each and every product. Then maybe one party have a positive mark to market on set of transactions. The other party may have a mark to market, positive mark to market on the other set of transaction. Then we try, if you net it, that means what would be the payment by which party to whom. Then if you have signed that agreement allowing the netting, then only that difference can be made from one party to the other party without transferring all principal amounts or settling each and every trade individually. That will drastically reduce your exposure to counterparties as well as credit risk. So that's why it says allow transaction to be aggregated and reduce the risk for both parties, not only for one party. It will reduce for both parties, but only thing is, before you do that, you should have netting agreement in place. Before you trade with the counterparty, you should sign this netting agreement. Then it will fix all the terms and conditions. What are the type of transaction we can consider in netting? What are the transactions that we cannot consider for netting? How do we do netting? What are the price sources? Everything will be specified in the netting agreement. But again, when we reduce counterparty risk through netting agreements, we face some other risk. Those are legal and operational risk. If something wrong in the netting agreement, that will give us some sort of a dispute or something like that. So then there will be a legal risk. Not only that, so we have to do mark to market, then net, and make the payment accordingly or receive the payments accordingly. So there will be a set of additional works that would add to operational risk. So whenever we minimize counterparty risk, we may face legal and operational risk. But again, put in proper controls, going through the legal agreements thoroughly, you can minimize those risks as well. So it would be beneficial to have this netting agreement even with this risk and taking some action to mitigate legal and operational risk as well. But from the legal side, what we have to make sure is that this netting agreement should be able to enforceable legally. Even though you sign a netting agreement with two parties in Sri Lanka, when you go to courts for some reason, if it is not accepted, then your netting agreement is null and void. It won't help you. So therefore, when you enter into netting agreement, we have to make sure that netting agreement is legally enforceable. Otherwise, it is not useful. Especially these things can happen because you do transaction not only with the local counterparties, you do transactions with the foreign parties as well. Then you have to sign the contract with foreign parties. Then say Sri Lankan party sign a contract with a bank in Middle East. What is the legal framework that we are going to take? With the Middle East country, or the Dubai legal framework or Sri Lanka legal framework. They may not agree to follow the Sri Lankan law. We may not agree to follow the Dubai law. What do? You will select a neutral place. Okay. The applicable law is London law or UK law. Then you have to have a thorough knowledge about what is UK law says in these netting agreements. So things like that can happen in any legal agreement in cross-border parties. So that has to be there. We have to consider that. This is an example of netting. So there are two parties, counterparty A and counterparty B. They have transactions, many transactions with in between A and B. Now we are assuming we are counterparty A, so that's why I mentioned that from the counterparty's A's perspective. Assuming we are the counterparty A and we have transactions with counterparty B. Then we calculate for all these transactions mark-to-market values. Then we found trades with positive mark-to-market is worth of 20 million. Counterparty A has positive mark-to-market for a value of rupees 20 million. Then obviously mark-to-market for the counterparty B is negative 20 million. So who takes the credit risk in this instance for these trades? Who takes the credit risk? Counterparty A or counterparty B? Who takes the credit risk of this 20 million? Counterparty A or the counterparty B?
Counterparty B.
Counterparty B takes the credit risk. Can you explain why?
B has negative 20 million.
So what does it mean? What does it mean?
He has
negative 20 million.
Has lent to A.
Sorry?
B has lent to A. Oh, he has obligation.
B, counterparty B has, who has the obligation? Counterparty B or the counterparty A?
B has the obligation.
So counterparty B has the obligation towards counterparty A. Then who takes the credit risk?
Then counterparty A takes it.
Yes, counterparty A takes the credit risk because he's having a mark-to-market gain. That means he's having a profit. How counterparty A is going to get profit? It's some obligation of counterparty B. Counterparty B has the obligation to pay that towards counterparty A. So therefore, the party which has a positive mark to market has the take the credit risk of the other party. So trades with positive mark to market from A's perspective, positive 20 million. So for this 20 million, counterparty A takes the risk. Then there's another set of transactions. For the counterparty A, that's a negative mark to market. So then it's a positive mark to market for counterparty B. Definitely, if it is negative for counterparty A, it should be positive for counterparty B, because these are transactions in between these two parties. So in this scenario, counterparty B takes the credit risk of counterparty A. Okay, assume now we don't have netting. We don't have netting. We have to settle each and every transaction. What would happen on the what would happen? Counterparty A will pay 20 million to counterparty B. Counterparty B should pay 17 million to counterparty A. But for some reason, counterparty A pays 20 million to counterparty B. Counterparty B didn't pay that 17 million. So without netting, the whole 20 million amount is at risk. The same thing can happen for counterparty B. So counterparty B puts 17 million into risk. Clear? If you don't have the netting agreement, you settle each and every transaction separately. Basically, ultimately, counterparty A pays 20 million and counterparty B is supposed to pay 17 million. But counterparty B doesn't pay. So counterparty A loses 20 million, not only that, 20 million. The amount of, yes, we lost that 20 million and not receive, sorry, counterparty A pays only 17 million. Sorry. Counterparty, because counterparty is losing 17 million. Counterparty A has to pay 17 million to counterparty B. Counterparty B has to pay 20 million to counterparty A. So assume counterparty A pays this 17 million, but counterparty B does not pay this 20 million. So this 20 million is at risk. On the other side, assume counterparty B pays 20 million, but counterparty A didn't pay that 17 million. Then counterparty B faces the risk of 17 million without netting. But what would happen if we net? A pays 17, B pays 20. The net amount is B pays 3 million to A. Correct? At the end of the day, even you settle all these transactions individually, the net payment would be 3 million from counterparty B to counterparty A. If we do netting, that is the ultimate result. At the end of the day, counterparty B has to pay to counterparty A 3 million. If it is not paid, the amount the counterparty A is going to lose is only that 3 million. And meantime, counterparty B does not have any exposure to counterparty A because the counterparty A has the mark-to-market gain on net basis. So counterparty B does not face any credit risk. Counterparty A faces the credit risk of counterparty B amounting to rupees 3 million if we have netting agreement. So that's the advantage of having netting agreement. You can reduce your exposure and reduce the risk. The other method is the close out to minimize the
So excuse me, sir.
Yes.
In the interbank money market, that netting is there, no? And
I don't think.
not netting?
No. We settle gross. You net only that, like check payments, slips, things. Ultimately, those would be on net basis.
So even repo and repo transaction is also the same gross basis.
Yes, repo. It's on repo basis, gross basis so far.
Okay, so when we calculate the next exposure with regard to one bank, that we can consider net basis, no?
Sorry, when we calculate the net.
The net position at the end of the day, the bank has liquidity. So we calculate on the net basis.
No, to calculate your liquidity, you consider the net basis, the net figure. That is your internal thing. But the settlement won't take place in that way.
Okay, sir.
So these netting is work on the settlement date. But the close out, that's a separate clause in agreement. So by the time the counterparty defaults, there may be a lot of open contracts to be settled on a future date. If you have this close out agreement close, you can close all existing transactions, not only the transactions to be settled today, but others also. You can do mark to market and close out. You don't want to keep it open until maturity date if you have this close out agreement. That will also reduce the exposure in the future. When you combine this close out with the netting, it will give you more advantage because it will net whatever the unsettled contracts still open.
So, sir, close out, the other party also should agree, no?
Yeah, this everything should be in the contract. No, you can't do by your own. The other party should be in agreement. So therefore,
So in order to reduce the risk, we can't do that also.
Before the event, you should have signed the agreement saying these are the terms and conditions. After the event, you can't do anything.
Okay. Then
the other method is taking collateral. So like in repo or in mortgage, you take some security to back your loan or the facility or the amount that you lend. In that also we have discussed this so many times, margin or the haircut. You take in the haircut you take in a repo transaction you take more than the value that you lend. That is also you can consider as a margin. But in general, margin is only part of the yes, it is only a part of the exposure, maybe 40% of the exposure or 30% of the exposure or 10% of the exposure, depending on the market or the product and the market volatility and things like that. You ask the other party to post some collateral as margin, and the in general scenario it will be in either way. Whoever who has the mark to market gain ask other party to place collateral. So therefore you may place margin or the other party may place margin with you, either way, depending on the depending on your position, who is having the profit in the transaction. So then in this this also there can be agreement saying, okay, say the mark to market gain is only say 1 million rupees. Do you think it's worth to transfer securities from one party to other party as collateral, paying all these transaction fees and things like that? If you think it's not, then both parties can come to an agreement, a threshold value. I'm not sure whether I have put it. Yes, I'll come to that later. So we take margin. I'll explain this. What are the other terms that in the margining? So, however, you take some margin to protect yourself. It can be either way, depending on which party has the profit. Then the other party, losing party, has to place the collateral. Then you make sure whether sufficient collateral are placed. And again, comes with a cost or a risk. Then you face the market, operational and legal risk. What is the market risk? The value of the collateral may change with the time. Then that comes market risk. And the operational risk, you have to send Swift message or whatever the messages, allocate securities and settle it. And even in the legal contract, there may be issues. So all those things comes with the collateralization to mitigate counterparty risk. Then diversifying counterparty risk. This is also important. You try to have set of counterparties, varieties of counterparties, and try to do business with many of those counterparties. You are not limited to 1 or 3 counterparties. If that party fails, your exposure so you get the diversifying or benefit of the diversification, not only in the market risk, even in the credit risk also. Then credit rating, as I mentioned, you look at the credit rating generally, or the norm is when you have high rating, low probability of default, so low risk. So therefore, depending on all those things, you may establish credit limits towards counterparties. You may establish limits towards counterparties, the concentration limits. It can be based on credit rating and may be based on the sector if it is not a financial entity, other entities, and maybe by the name. Counterparty A, this is the limit. Counterparty B, this is the limit. And meantime, you might have for this sector, for the health sector, this is the maximum limit we have. Within that, you might have 10-15 name with limits, special or maximum limit for against each name. That can happen. Credit rating also the same. When you deal with different countries, the country limits. Again, the name matters. One bank may have presence in different countries. Then what is the country that you take as the exposure? then you have to count that exposure towards that country and measure it properly. So to mitigate the political and other country risk, you put country limits as well. And maybe these limits depending on the maturity. For the same party, you may give a higher limit for short maturities and lower limit for longer maturities. These things can be done to minimize the credit ratings, but the question is, how do you come up with these figures? How do you decide, okay, bank A, 10 billion rupees exposure, how do you derive that 10 billion? Why not it's 15 billion, or why not it's 5 billion or something like that? So you have to come up with a model to derive those figures. But or else you can use rule of thumb. So you just, based on the past experience or your gut feeling, you say, okay, only 10% of our portfolio will have exposure to this party, only 5% or only 1 billion, whether it's relative terms or absolute terms. That is, even that will help you to diversify and reduce the concentration limits or concentration towards few parties. Then sorry.
Now, let's say we are going for an investment of a debenture. So the debenture issuer is a commercial bank. But after some time in the secondary market, I have bought it via some, let's say, an investment bank. I bought it from an investment bank in the secondary market. So when it comes to the counterparty risk, in this example that I said, it reflects to commercial banks' limits or the secondary market person.
Both. First thing, in your exposure in the long run up to the maturity of the debenture, you take the credit risk of commercial bank.
Okay,
that's fine. So therefore, what is your concentration towards commercial bank? You have to think. That's the first thing. Then the second thing, you enter into a transaction to buy this debenture through another bank. In the secondary market. So on the settlement date, you pay cash. If you don't get that bond, there's a risk, settlement risk. But mostly bonds are DBP. Therefore, the risk is minimal.
So in this instance,
in that instance, that risk also you have to consider that one as well. Then considering that the DVP nature, you may take into account a small amount of the exposure.
On the settlement date, I'll be paid by the I'll be not paid by commercial bank. No, I'll be paid by the
on the settlement date. Nothing to do with commercial bank. Commercial bank is just the issuer. The commercial bank is bound to pay coupons and the maturity.
Coupons and the maturity. So on the maturity date, the maturity proceed will be received to me from commercial bank or that investment bank.
From commercial bank.
Because
when you buy it from the investment bank, on the settlement date, the whoever book runner should update the register.
Okay, so
then that ownership should be transferred from that bank to your name.
So let's say the bond is maturing in 2025. So I'm buying it today from the investment bank. The settlement date is also, we'll assume it's today. So this specific settlement date risk is with the investment bank.
Investment bank, yes, nothing to do with commercial bank.
But at the end of 2025, the risk is with commercial bank.
No, from tomorrow onwards, you take the risk of commercial bank. Not really tomorrow. The moment you purchase, come into agreement with the investment bank to buy that bond, you expose to the commercial bank.
commercial bank. In between, until the transaction gets settled.
Settle, you get the exposure. In addition to that commercial bank exposure, you get the exposure towards the investment bank.
So are there regulations, are there practices to cover that risk also, for the 2 day or 1 day risk?
Yes, there should be that, but as if you want, you can ignore it, assuming that it's a DVP.
Yeah, DVP.
But the thing is, so on a DVP, you may not lose principal amount, but you won't get the bond. You will end up with your cash. Then you have to go to the market and find the same bond again and enter into another transaction. So there will be a cost. That is the replacement cost that we consider. If the market price has gone up, now we have to pay more.
If I had agreed for a good rate with the investment bank, and if he defaults after some time, when I go and buy, the rate is higher. So that cost is there.
Yes.
Thank you.
Okay. So hedging, I'm not going to explain this again. We discuss how do we hedge counterparty risk using credit derivatives, credit default swap, and credit options, credit link notes. So these are none of these available in Sri Lankan markets. However, these are possibilities to minimize your counterparty risk. The other one is way of managing the counterparty risk is exchanges and centralized clearing houses. This is the topic close to the assignment. So here also, as we discuss in the futures, whatever the, say, bond transaction between counterparty and counterparty B, once we report it into the centralized clearing house, what do? They separate that transaction into two. In between counterparty A and the clearing house, and counterparty B and the clearing house. Then both parties takes the risk of the clearing house. That's how exchanges and centralized clearing houses reduces the counterparty risk. Then all parties, for transactions which are settled through the clearing house, takes the risk of the clearing house. But then clearing house takes a huge risk. For that, there are mechanisms. So you may need to place margin and things like that. That will help to reduce the counterparty or the credit risk of the clearing house. However, this sort of mechanism, what does it do? It simply redistributes the counterparty risk. It doesn't completely eliminate, but the counterparty risk which was there in between two parties, direct parties, party A and party B, now it is redistributed towards centralized clearing house. But again, that may generate operational, liquidity, and systemic risk. If many parties fail, then the CCP or the central counterparty or the clearinghouse may be at a risk. That will trigger the systematic event. So that you have to be very careful and take necessary actions to reduce that chance. When we
Sir, excuse me, sir. There liquid risk means liquid risk of the clearing house.
Not only, even the products and things like that. Whatever the products you may not be able to liquidate quickly and things like that. There will be a high demand or high selling pressure on the same product. That these things can happen. And your liquidity as well.
The thing is the clearing houses are regulated or not?
Clearing houses are regulated.
Okay.
So when it comes to quantifying the counterparty risk, you can do it at different levels, in aggregate or in separate divisions or sections. So basically, the most common thing is you quantify that at the trade level. For each and trade, what is the credit risk? What is the related risk coming out of that particular trade for the credit risk? Then you measure it against the counterparty. So from a specific counterparty, what is the credit risk that you get? What is the contribution from a particular counterparty towards your total credit risk? You measure it at the trade level, at the counterparty level, then you measure it at the as an aggregation at the your total portfolio level. What is the total credit risk of my portfolio? So at 3 different levels, at least in general, you assess this or quantify your exposure. But if you need, you can introduce some more levels. So you may introduce okay, sector wise. What is the credit risk coming from health sector? What is the credit risk coming from the financial sector? What is the credit risk coming from the public consumer goods sector or whatever? So likewise, you can quantify this at each level depending on the correlations. Those things may not add up straight away. The aggregate level, it may not be just the simple sum. It may be more or less than the simple sum. Probably it may not go beyond the simple sum. Due to diversification, it would be lower than the sum of each amount, because of the correlation. When one party goes bankrupt, it may be good for another party or something like that. The relationship may be negative, so that will give you some cushion. That can happen. That depends on the interrelationships between the counterparties. Then another way of quantifying, and this is used to price the derivative transaction. You when you take the credit risk, you need some compensation. This CVA, credit value adjustment, is the price that you add to the product as a compensation. So the other party with lower credit quality, the CVA is a cost for that party. So that's why it says the CVA is the market value of the counterparty credit risk. When you price, you consider this in pricing. So this is the definition given by the Basel Committee on Banking Supervision. CVA, it's the risk of losses arising from change in CVA values in response to changes in counterparty credit spreads. Whenever the counterparty risk changes and the market risk factors changes, what would be the contribution to the total credit risk in whatever transactions that we discuss? It may be derivative transactions or securities financing transactions such as repo transactions. So this examines the counterparty risk. You can do that at the both at the trade level and the counterparty level. And you put the limit on CVA at the portfolio limits. You can do that as well. So how do you calculate the CVA? This is the equation. It's sort of close to expected loss, you might see. This is the loss given default if the counterparty defaults. But there can be many exposures and relevant default probabilities. Default probabilities during a specified period. Here it says within a 1 year period. And E is the expected exposure, and it's discounted. So the expected exposure may be on a future date. Once you discount it to today, what is the exposure? So you multiplied exposure by the expected exposure by the probability of default, then you add them together, multiplied by the loss given default. What is out of this exposure, expected total exposure, what would be the loss that you incur? That's how you calculate CVA. And this VA value adjustments, this credit value adjustment is only one measure. So there are few more measures. In general, we call them XVAs. We call them XVAs. You can calculate different measures to measure. So whenever we say X, it's a variable. It can be replaced by C or some other, or liquidity or book, something like that. So there are different definitions on all these things. It measures somehow the credit risk, but mostly CVA is used to measure the credit risk and to price the credit risk into the product. Then we'll move into collateral management to discuss. Yes.
So in the second 20 first slide, it says what is trade level?
Trade debt level means you may enter into different transactions with different parties. For a one transaction, what is the credit risk? Say you buy a bond from a party, what is the credit risk that will generate? If you enter into a forward contract with the same party, what is the credit risk that you get due to that transaction, specific transaction? But in the counterparty level, you collect that bond transaction, forward transaction, and whatever the existing other forward transactions and report transactions, everything. Once you put all them together, what is the risk coming from that counterparty? Is it clear?
Yes, sir. That means trade level includes one transaction, and counterparty includes one counterparty, and portfolio different counterparties.
Different counterparties, different rates, all together. Yes.
Okay, sir. In case of that CVA calculation, so do we have to calculate depending on various factors such as it's considered the variance of market risk, no? So do we have to calculate different
that all will be priced in the EE, most of the things. What is the expected exposure? You may have to do a forecast. What would be the exposure to this party after 1 year's time? So then you may have to do some simulation or things like that. This is not a very straightforward calculation.
No, I would also, sir, do we have to calculate separately that risk, market risk, so can calculate at once?
No, we don't calculate market risk here separately. So what we need these measures, but when we calculate these measures, we have to think about the market movements. Say you have an interest rate swap transaction. What would be your exposure to the counterparty because of that interest rate swap transaction after 6 months? How do you know? You don't know. Because that depends on the interest rate prevail at that time. So you have to have some sort of a simulation or forecast and come up with expected exposure. So these are not easy task to carry out. You need a lot of computing power and forecasting models.
So this means changes of the credit risk due to changes in the counterparty is market changes.
Yes, because with the market changes, your exposure changes. With the market changes, maybe probability of default also changes.
Okay, sir. Thank you.
Although you have to consider all those things. Collateral management. What is a collateral? I think you know what is a collateral. It is an asset that we take, support our risk or minimize risk, and we should be able to legally enforce that and acquire that asset. If you think the collateral that you know, say if you take a mortgage, only one party pays the collateral. Place the collateral with the other party. Borrower plays the collateral with the lender. If you take the repo transaction, same. But when it comes to the general market, especially with the OTC derivatives and things like that, the exposure may swing from one party to the other party. Today, party A has the credit risk of party B. Tomorrow, party B has the credit risk of party A. So therefore, the credit risk changes. The exposure changes. Based on that, whoever has the negative exposure plays the collateral with the other party. That's why it says often bilateral. Both parties has to place collateral depending on the position and the value of the position. So as I mentioned, when you have a mark-to-market, positive mark-to-market value, you ask other party to place a collateral. When you have a negative mark-to-market value, you place the collateral with the other party. So why do we do that? When you have the collateral, your exposure to the other party get reduced, but your limit remains same. So then therefore you can do many trades. If you don't have the collateral, one transaction may say exposure may gives you 10 million exposure. But if you take 5 million collateral, then the exposure reduces to 5 million. Then you have another 5 million cushion. You can trade with that party. So that will reduce credit exposure and enable more trading. Not only that, we discussed earlier, you trade with the highly rated parties, or you decide because of the credit risk. But with this collateral, you can bring that requirement to a lower level, but to mitigate the risk, ask the counterparty to place collateral. So that will add you more counterparties. You have the ability to trade with many counterparties. From the regulatory perspective, capital charge would be less if there are collateral. The capital charge on a naked product would be high than the capital charge for a collateralized product, and that charge depends on the type of the collateral and the margin value and the product and things like that. However, when you have the collateral mechanism, capital requirement will be lower. It will give you a more space to do transaction. Not only that, when you price the product, since you have the collateral, your credit risk is low, then you can give a better price for the counterparty. Instead of charging more, you can charge less because the counterparty risk is addressed through the collateral. So that can be done. So that's the advantage of having collateral. In collateral, especially with regard to derivative transactions, you sign this ISDA agreement. International Stock and Derivatives Association. That's the very standard agreement that you sign in the international market. Even in Sri Lanka, we have asked to sign this agreement. In that agreement, in this is the master agreement, it covers the derivative product. How do you trade derivatives? What are the derivative transactions that you trade with this party? What are the how do you do mark to market that derivative? What is the law? All those things will be there. But in that agreement, there's a annexure called credit support annex. That annexure specifies you how do you handle the collateral whenever you have margin in. How do you handle that? What are the type of collateral that both parties agree to accept? Not anything that you can place as collateral. Whether it's only cash, whether it's cash and government bonds, or only treasury bills, or you accept corporate bonds as whatever. So it specify all those things. I'll come in the next slide. And the agreement is highly standardized, so it's common for everybody in the market. Only relevant variables that you have to change. If you want to have margin 40%, what you have to say, okay, margin requirement is 40%. That's likewise. What are the collateral that you accept? You can list it there. So likewise, the CSA agreement, CSA credit support annexure specified or govern issues like this. Collateral eligibility. As I mentioned, what are the types of collateral both parties agrees to pay, agrees to receive as collateral? Whether it's only government bond, whether it's only cash, whether you take treasury bills, commercial papers, or any other promissory notes, whatever. So that's specified. Or what are the in which currencies should those collaterals be denominated? Things like that. Then interest payments, whether you for cash collateral, whether you pay the interest or not. If you pay interest, what is the rate? It's not 4% or 5% the figure. What is the benchmark rate that you link? Then when do you transfer this collateral? So assume you do the mark to market today. Then you calculate the collateral requirement. Do you have to immediately transfer that collateral, or you do it with a 1 day lag or something like that? So then there's both parties know when to do these things, how to do these things. That will lead to less problems in agreements when we have a standardized agreement. Then posted collateral calculation. How do you calculate the value of the already posted collateral? Then if it is not enough, only the other one party has to place more collaterals, and whether you need any haircuts requirements on the collateral. Say margin requirement is 40%. If you place the government bonds, it's okay. 40% is enough. If you place a corporate debenture as collateral, okay, I need 10% haircut. So likewise, depending on the different collateral type, you can specify haircut requirement as well. Then whether you can substitute collateral. What does it mean by substitution? Say you place security A as the collateral. Tomorrow you want to replace it with security B. Take out the security A and keep the security B. Whether the agreement is allowed to do that. If allowed, how do you do that? First, whether you have to place the new collateral with the counterparty and withdraw that collateral, or whether you can do that simultaneously. All those terms are specified in the CSA. Then timing and methods of valuation. What are the prices that we take? At what time? Whether we take the 12 noon price or 4 o'clock price or 8 a.m. in the morning. What are the prices that we use to value the collaterals. Then what are the methods of valuation? All those things are specified in the CSA. Reuse of collateral. What does it mean? I place a security with you as a collateral. Whether you can use it to place as a collateral with someone else, or whether you can sell it in the market, that is reuse of collateral. Whether it's allowed or not is given in the CSA agreement. If it is not allowed, the party who takes the collateral, they can't do anything unless keep it in its custody. Then finally, it explains how do we handle any disputes if arise. Whether you go for arbitrage or arbitration, or go to court, or what is the mechanism to resolve disputes. All those things are specified in this collateral management CSA credit support annexure. So as I mentioned, that's credit support annexure establish some threshold. What is this threshold? Say mark to market gain, as I was told you earlier, mark to market gain is only 1 million. Is it worth to other party to ask other party to place a collateral? It may not. The transaction cost may be more than that. So therefore, there will be a threshold. Okay, if the mark to market figure goes beyond this only, we ask for collateral. Then if it is the case, what is the initial margin? Whether 40% or 10% of the exposure. That is also specified. Then say that there can be a collateral requirement of just 0.8 million. Again, are we going to transfer? So the initial margin is given. Initial margin is say 5 million. Now you have 4.2 worth of securities in as collateral. There's a gap of 0.8 million. Are we going to place that 0.8 million worth of securities as collateral? So it may not be. The minimum transfer amount is specified. Okay, if the amount required is below that minimum transfer amount, we don't transfer that, or we don't place collateral. If it is higher than that, yes, we'll do that transfer. Then round in, whether in calculations you will get a lot of decimals, and as I mentioned 4.28 something like million or some other figures. Are we going to round off it, or round up, or round down, and up to what level, whether it's up to the nearest million or the nearest rupee or something like that? That's parameter that is also established with the CSA. As I mentioned, the haircut requirement for different products, different collateral, there will be different haircut requirements. Then the credit quality of the collaterals, whether that should be AA or the AAA, something like that, and the minimum amount that they have to place with the party, the credit support amount. So to meet the initial margin, minimum margin, what is the amount that you have to transfer? So all those things are specified in the credit support annexure. So the reason I chose these things, I think even in the Sri Lankan market, these are the things that we need to develop. Some of these are not practiced properly. So for repo transaction, we sign something called master repo agreement. But when you say master repo agreement, the agreement should be same for each and every party. But in Sri Lanka, Bank A has a master agreement, Bank B has another master agreement. So it is not a master agreement. There should be a common template where you are allowed to change only the terms. Okay, what is the interest? Oh, not the interest rate. What are the collateral accepted? things like that. What are the things addressed should be same for each and every party. So there should be standardization in the market, which I see we are lacking. So even in this counterparty side also, I see these things are lacking in our markets. So with the knowledge on these, even if you have opportunity, do more studies and try to introduce whatever possible in Sri Lankan market to minimize and to better management of the risk, and that will help to improve the actions or the activities in the domestic market. So I think that's enough. I don't know. Okay, exactly on time. So that's all I want to explain you about the credit risk and the counterparty risk. Mainly, as I mentioned, I focus on the counterparty risk because in general credit risk is a vast area. Even you grant a loan to a customer, individual customer, to a corporate client, or trade with other banks, other counterparties, everything comes under this credit risk. We don't have time to go, not necessary to discuss all those things. I just give you some flavor with regard to what are the things that you should consider mostly from the treasury perspective, or in the related or the peripheral areas. So if you have any questions, I hope you learn something on credit risk, new things through this session. I know that you have done a lot of banking exams and things, and you have done credit management, but I'm sure some of these are new.
So page number 22. Is there any calculations will be related to this on?
No.
Exam?
No. In the exam, I'm not going to ask you to do it.
Thank you, sir.
But have an idea what is CVA? What are the factors that comes into the calculation? Why do we do this and things like that? Have a broad idea, not the very deep in this credit session.
So what is meant by the credit support amount in the last slide? That is 27.
It is the say when you don't have the minimum margin or the initial margin fulfilled, the additional amount that you have to bring collateral.
Means when
Yes,
that initial margin is not there, only we require that.
Yeah, if your value of collateral goes down, then you have to top up margin. Initial margin is takes at the very first instance 40% of the exposure. Then if it goes down, you have to top up and bring it back to the that whatever the initial margin or the margin requirement amount.
So what is the ISDS stand for?
International Swaps and Derivatives Association. The agreements, the agreement is available online. If you can download and go through, it's a lengthy document. You will see what are the things that we have to think or consider when we enter into transactions.
The next week's the lecture will be on 1:30 to 5.
Yes. Again, to just that's good. You remind it from next week. It will be at 1:30 on the regulations. Maybe 2 or 3 weeks.
Some other lecture will come more.
Yes. Mr. Sajun will come and do that.
So we will be meeting again for the revision session. No?
Yes.
Thanks, sir.
Okay. Thank you. Anything else? In the revision, I think you come up with questions and we'll discuss. I'm not going to go through all these again. So we did it about 20-30 weeks. That means about at least 100 hours. Within 4 hours, we cannot revise everything. So better you do your homework, come up with questions that you have, not the questions that I gave to you. Do that, and so come up with questions. Why this like this, or things like that. I did this calculation, but I didn't get the answer. What is the reason? Things like that. Come up with, do it by yourself. Then you face some problems. Try to resolve that. If not, come with that question. Then we'll discuss that. Then we can touch the basic, say, bond pricing. Okay, what is the bond pricing formula, or the available methods? What is those? And quickly revise that. So because we don't have time to do all those things. Is it clear?
Is there any chance to discuss about the practice questions which we received?
So that's what you do that and come up with questions on that as well, or whatever from the theory as well. In that revision we can discuss.
Okay.
In the revision class, if you do, so you should be able to say you have a problem with a particular question. So if I ask question number 2, then I'm not going to solve it from the scratch. You tell me what are the steps that, or how did you try to resolve it? What is your approach? Then I'll tell you, okay, whether the approach is correct or wrong, whether the theory that you are going to use is the correct theory, whether you have applied it properly. Things like that will go in that way.
See, we got the last examination past paper. Is there any chance to get another past paper?
We can discuss that as well. Yes.
Can we have another past paper as well? Or is there any chance to have another one, another paper from the institution?
You may be able to, but I don't think it's that much useful, because things have changed slightly with the time. Some of the questions you may not be able to answer. Some of the things that we discuss may not be appear in the past papers. So both sides is there. But basics, yes, some of the basic topics, yes, possible.